US stock markets moved lower today as investors reacted to renewed uncertainty surrounding Federal Reserve leadership and the broader economic outlook. Major indexes declined as market participants reassessed expectations for interest rates, inflation control, and future monetary policy direction. At the center of today's market reaction is growing sensitivity around the Federal Reserve. Investors are increasingly cautious about how potential leadership changes could influence policy decisions at a time when markets remain highly dependent on central bank guidance. The Federal Reserve plays a key role in shaping financial conditions across the economy. Its decisions directly affect borrowing costs, business investment, housing activity, and consumer spending. When clarity around policy direction weakens, markets often respond with increased volatility. Today's decline reflects concerns that interest rates may remain higher for longer than previously anticipated. Higher rates raise financing costs and can pressure corporate earnings, particularly for growth-oriented companies. Technology and high valuation stocks were among the weaker performers, as investors adjusted expectations for future earnings growth. Financial stocks also faced pressure, with uncertainty around rate policy affecting lending outlooks and profitability. Bond markets echoed this cautious tone. Treasury yields shifted as traders reduced expectations for near-term rate cuts, signaling that markets are becoming less confident about aggressive monetary easing. From a broader perspective, today's market move highlights a fragile confidence environment. While parts of the U.S. economy remain resilient, investors continue to balance optimism about long-term growth with near-term risks tied to inflation, policy uncertainty, and global economic conditions. Market analysts note that sessions like this are driven less by a single event and more by overall uncertainty. Until investors receive clearer guidance from the Federal Reserve and stronger confirmation from economic data, volatility is likely to remain elevated. Despite today's pullback, analysts caution against overreacting to short-term market moves. Periodic declines are a normal part of market cycles, particularly during periods of policy transition. Looking ahead, investors will closely monitor upcoming economic data, inflation reports, and comments from Federal Reserve officials for clearer signals on the future path of interest rates. In summary, U.S. stocks declined as uncertainty surrounding Federal Reserve leadership and monetary policy weighed on investor sentiment. Markets remain sensitive to policy signals, and volatility is expected to continue in the near term.